This Week in Economics from WBRN Radio and on the Bostonred Network. This is the Numbers Man Show as they decided to coin us. You can find us on Google Podcasts, Twitter, YouTube, Spotify, iHeartRadio. Seems to be the favorites of the people. Stitcher, I'm sorry, not Snitcher, Stitcher, and Spreaker. We have Facebook. You can find us floating across there, and various other favorite destinations for your internet radio products. We are there. This is our macroeconomics program. We do it normally weekly unless special events occur. And we partner with Cranston Analytics. We've been doing this now for roughly 15 years or so. Before we were with Cranston Analytics, we were, let's see, what were we? Let's keep changing the name there. Everybody decided to go into the analytics business. And at that time, we were at Ecnomics 2010. That is still our Twitter feed. And also, we called the organization at the time, we registered with the Fed as Cranston Economics. Was that it? Let's see, economics. Yeah. Anyway, the name continued there. We fashioned it after, at the time, there was a website called economics.com. That has since been folded into Standard & Poor's, and Dr. Zanke is now a part of it, is part of Standards. Nonetheless, they are there. Everyone, as they say, has moved merrily along. Since we came into the game, modeling that is, there were a few, and now there are many. There are over thousands of modelers out there, various types of analysts that cover any dimension you want to talk about. If you want to talk about real estate, they're there. If you want to look at the automobile sector, there were always automobile analysts. But in the real estate sector, there's Zillow there, some that I can think of right off the top of my head that are there. And of course, you have CNBC, you have Reuters, BBC to a certain part, covering international finance and economic matters, and various others that are in the market. At one time, we did even market timing, if you can guess with that particular one. But there's still market timers out there. We'll talk about an IPO today. WeWork, I think, is the name of the organization. Anyway, we'll get to it. It's one of the IPOs that the analysts don't think will come off, as some of the others have been lukewarm in the past. Anyway, let's go now to Reuters and solid economic retail sales. Calm the words about the economy. This is on. This is by Lucian, published on the 13th of September. U.S. and we'll dive into these in a minute. U.S. retail sales increased more than expected in August, pointing to solid consumer spending that could continue to support a moderate pace economy. And this is at that moderate pace. Department of Commerce could further allay financial markets' concern over recession, which has been fueled by a year-long trade war between the U.S. and Canada. The trade war, we've always maintained at this mic, is secondary. Still, the Federal Reserve is expected to cut interest rates next Wednesday, this Wednesday coming up. Some of the hint from trade tensions on the longest economy expansion in history. Chair Powell said last week he's not forecasting or expecting a recession, but reiterated the central bank will continue to act as appropriate to keep the expansion now in its 11 years since the Depression on track. The Fed lowered borrowing costs in July for the first time since the Depression. That was 2008. The winds of recession aren't coming close to shore if consumers continue to buy their hearts out. That is from Chris Racky, the chief economist at MUFG. Federal officials are unlikely to cut rates too much deeper as they seek to get out in front of the risks the economy faces, acting early instead of being too late. The sales rose paltry, in our opinion, 0.2% last month, lifted by spending on motor vehicles. That's traditional in August and September. Building materials, healthcare, and hobbies. Data from August revealed slightly up to show retail sales increased at 0.8% instead of 0.7% as previously reported. Economists from Reuters had forecast retail sales gain at 0.2% in August compared to August last year. Retail sales advanced at 4.1. Retail sales have increased for 6 straight months, the longest stretch since 2017. Nothing to write home about there, but with the Trump administration's this month slapping a 15% tariffs on consumer goods such as TVs, apparel, bed liners, smart watches, footwear. There's concern retail sales could pull back. Economist retail groups expect businesses will pass on the duties to consumers. It's too early to assess the impact of the new tariffs that take effect. Some of those have sort of been called back. That is from Jack Kimhinsey, chief economist at the National Retail Federation. That's in Washington. Household worries about new rounds of tariffs were also underscored by a small rise in consumer sentiment this month. University of Michigan said the consumer survey found concerns about the impact of tariffs rose in early September. And we don't have that one, but we'll get it. Expanding automobile, gasoline, building materials, food, retail sales climbed 0.3% last month after increasing by a smaller downward revised 0.9 in July. These so-called core retail sales correspond more closely with consumer spending component of the GDP. They were previously reported to have jumped 1% in July. Consumer spending, which accounts for 2/3 of the economy, increased at a 4.7 annualized rate in Q2, the most in 4.5 years. Economists expect consumer spending will slow to just below the 4% rate in Q3, which would be more than enough to keep the economy humming along. Trends in consumer spending growth still look very solid. That is from Michael Ferrari, an economist at J.P. Morgan. Consumers remain the locomotive of the economy, but the locomotive could run out of steam. Inventories increased bode well for GDP growth. The Atlanta Fed is forecasting economic growth at 1.8 rate in Q3. The economy grew at 2% rate in April to June, down from a brisk 3.1. You're not going to see those days anymore. Nonetheless, the Fed will meet next week, the 17th and 18th. Most economists expect monetary policy easing in October and December. In a fourth report Friday, the Department of Labor import prices dropped at 0.5% last month amidst decline in the cost of petroleum products and food. The 12 months through August, import prices decreased by 2% after dropping 1.9% in January. Low inflation, the lowest unemployment rate in nearly a century, and about 1.27 trillion in personal savings underpinning consumer spending. I was talking to a guy at the market that was investing in his home, repairs that is, so he can sell it at a greater price if he has to leave. He's in his late 60s. Automobile sales accelerated at 1.8 after edging up just 1/10 in July. Sales at building materials and gardening stores jumped 1.4, the most since January. Online mail order retails increased at 1.6 after shooting up 1.7. Receipts at service stations fell to 9/10, reflecting cheaper gasoline. Furniture sales also dropped 5/10 there. Let's go to the actual numbers themselves. This is from the U.S. Bureau of Census announced the estimate of U.S. retail sales and service for August. This was put out on Friday the 13th, unusual day, but that's when it happened. Advanced estimate of retail and food sales for August, adjusted for seasonal variation, holidays, trading day differences, but not for price changes, were at 526.1 billion, an increase of 0.4% from the previous month, 4.1% above the August 2018. Total sales for June 2019 through August of 2019 period were up 3.7% from the same period a year ago. The June 2019 to July 2019 percentage change was revised up to 0.7%. From 0.7%, to 0.8%. Retail sales were up 0.6% from June of 2019 and 4.6% above last year's. Non-store retailers were up 16% from August of 2018, and motor vehicle and parts dealers were up 6.8% from last year. General information: the advanced monthly retail report is scheduled for release on October 16th. That's when they'll put the advance out there. And about what it is, the reliability of estimates. The estimates presented in this report were based on a sample survey. They contain sampling errors. So in other words, corrections will occur later in the ball game. And we won't get into the API and those kinds of things. And the kinds of businesses, estimate of monthly sales in retail food by the kinds of businesses here. Motor vehicles, that was 3.3 change. Percentage change, that was from 2018. And we look at various things here. Gasoline at gasoline stations, retail sales data here. The change was 3.6, retail at 4.2. Automobile, motor vehicle and parts dealers, there was a 3.3 change there. I think we talked about it before. 115,000, 576, there was the figure. I believe this is in the thousands, a million, sorry about that, is shown in a million, so let me just redo this again. 107 million, not 119 was automobile. No, it was new cars. We didn't get that one. Furniture and home furniture stores, 75 million, that was a negative 0.5% there. Electronics and appliances, where were they? Negative 4.1, that was at 60 million there. And building material, 0.4, 256.296. Beverages, the increase was 3.2 there. Beverages, food and beverages did well. Health and personal care stores, that was at 3.9 there, and we don't have pharmacies there. Clothing and clothing accessories usually that, but it was only 1/10 there, and again we don't have those figures. The breakdowns there: general merchandising stores at 0.17, and department stores were negative 4.5. They've not been doing so well. Non-store retailers at 12.1, they did better. And food service and drinking places at 3.9 are 511,729 was the score there. So let's see what we have here. That's just some of the scores. Anyway, this will be further revised, so we're kind of looking at this. Okay, July 2019 at 0.4%. This was the total for retail food. And it was in August of last year, it was 4.1. You can see where that is going. And motor vehicle and dealer parts, it was 1.8 in July of 2019, as opposed to August of 2018, 6.8. Much more robust, so the figures are down. Sporting goods, hobbies, and musical instruments, bookstores. This time around, they were at 9/10, and in 2018 at 2.1. You can see basically what is going on here. And it's negative 1.2 for food and drinking places, and it was 1.1 last year. We just got a shot past that. This is just a snapshot of how these businesses are doing this year around. Is overall, the idea is to get sort of an understanding of where retail is according to categories and how the changes were. Some went up. Home furnishing stores were up. Electronics stores, a little better, 1.2, I think, and it was 0.5 the last time around. Previous month to current month, some of the figures here, and the medium anyway. The average revisions here, this was for the month of August 2019, what the revisions were. I guess that's what I just gave you. The medium was 1.9. The previous month, let's see, this is on food and beverages. Wait a minute here. Excuse me. 0.2, and it was 0.7. I'll get down here in a minute. 0.8 was building supplies. Look at what's going on here. Anyway, this is some of what is going on here. The retail picture is not going to be that stable for the next few months. We can estimated measurement of sampling and variation revision to advanced estimate there. And, again, these are revisions. Revisions from month to month. Changes here, well, 1/10. This is total for food and retail and food services. Motor vehicles, 2/10 was a medium absolute revision. And most of these are very, very low. If you look at them, healthcare stores, 2/10 was a revision there. Sporting goods and hobbies, music and everything else, 5/10 was the revision, and 1 point average. Anyway, move along here. Citigroup, what's Citigroup up to? Stands by card strategy despite economic clouds. This is Wall Street analysts and begin to question whether Citigroup big bet on credit cards will backfire as the economy enters a recession, despite the bank saying it is underwriting the responsibility. So they're big on cards. It is the third largest card issuer out there, according to industry publication Nielsen reports. Its credit card accounts for 1/3 of overall revenue and half the profits of consumer businesses. Citigroup is also amongst the most aggressive promoters of zero interest balance transfers, according to research firms tracking that. These deals tend to lure borrowers with debt burden rather than affluent spenders who chase rewards. Now, this is very important. The rewards, less that, offers 4 credit cards, a zero interest balance transfer. Most major rivals offer one or 2 cards with zero interest transfers, according to Ted Rossman, a credit card industry analyst at the consumer financial company Bankrate. They've been around for a long time. LLC, the banks also offer the longest interest-free period on the market, with one card at 21 months compared to the industry standard of 12.16. That's about a year there, according to Wallet Hub's analysis there. The risk is Citibank is over-indexing to credit cards, said Wells Fargo analyst there, Mike Mayo. They're worried every day about what's going wrong. We are worried every day. Still, the credit card business continues to perform well. Mayo has given a buy rating to Citibank's stock, which is up 35% this year. Elizabeth Fogarty, speaking for the bank, says responsible lender, though balance transfer offers as well as other products. Fogarty said there's one level within the strategy, balanced growth strategy. We diligently monitor the market and the environment, mental conditions on a continuous basis. I would imagine she would. Some analysts say potential downside with borrowers like Jacqueline Orverdo, Pennsylvania truck driver who owes $12,000 in credit card debt. That's not very high. Orverdo, 40, said she has moved balances around on 19 credit cards, including one from Citibank. If the zero promotion offer dries up, she said, so does her hopes of paying off the debt. The only way I can stay afloat, she says, oh boy, with 19 cards, not advisable. She needs a financial planner. Citibank's card delinquency rate are far below the industry's average, according to federal data and filing. After this article was published, it's on September 6th, Citibank provided data to show its mail promotions of zero balance offers had declined significantly over the past 2 years. It now accounts for 13% of their business and 25% of the fourth quarter. Statistics from third-party research, again, Mintel Group Limited, shows it remains one of the top 3 promoters, according to the data. The other two, Discovery Financial Services and Capital One. Discovery, known for flooding mailbox with offers, said on its earnings call it's pulling back on the promotion offers there. Capital One, who pioneered it in the early 90s, this said public investors call it has been more conservative in extending credit. Two companies declined to comment. Consumers apply for balance transfers are considered riskier than those who don't. In other words, they want something different, relying on plastic after receiving free taxpayer bailouts to survive. During the Depression, the financial crisis, Citibank exited many business and narratives focused to a few key areas, including credit cards, online marketing, and checking savings accounts. 28 million cardholders, Citibank $2 billion in consumer deposits during the first half of this year. This is more than double what it gathered all of last year. Most consumers who sign up for these deals may be risky. Citibank is betting they will stick around once the promotion period expires. At that point, they face an annual rate, oh boy, up to 27%. Who would stick around for something like that? Citibank's interest-bearing balance rose 10% in the second quarter versus the year-ago period. That growth boosts overall profits by 9%. The good news is not Citigroup's 2007, said Mayo, the bank analyst. There's a better risk control, better where potential downfalls. Citibank started scaling back promotion offers in 2017. Citibank also added new features to encourage borrowers to use their credit cards more. The bank this year introduced a new card that rounds up to the nearest 10 reward points on every new purchase. Our Amex, American Express, has very similar type of offers that they put out to the public. Let me go to CNBC here and just look at some of the general headlines here. This is on the political side. We talked a little bit about this. Families behind Oxy concealed a transfer of millions of dollars, about $1 billion, according to the Attorney General in New York. Having some problems. Some of the movers on the market here, the top moves, this again is CNBC, DuPont, 156%, Freeport, whoever they are, Pioneer Natural, they all have 7 in the threes there. And some of the bottom here, CenturyLink at 4.656, Progressive Corp at 5.486. They're all in the red. And Altera Group at 3.691. So these are some of the ones that are not performing very well. Interesting in the that particular model there. And the Russell 2000 at plus 3.07. The VAX at 13.47. A negative 0.48 there, or negative 0.3%. They were down. The S&P was also a negative 2.18 and not 0.07% in the negative there. The Dow was in the positive. We'll give those numbers later. And let's move on here. Coming contract talks with United Auto Workers out of Detroit. All kinds of problems going on in Detroit. We won't go into them here, but some people are under indictment there. The UAW Region 5 conference there, what had happened, New Year's Eve party and several other things. There, blue-collar union workers had Ford, GM, Fiat, Chrysler. So they're in contract talk. President of UAW, Gary Jones, and the former president, Dennis Williams, their homes were raided. This is a very unfortunate situation. But they have not been charged with anything, period. And this is kind of a typical situation going here. And that is more in the past, we think, than in the future. It does crop up, not very good, this type of living. And we had it on the political side is Bostonred Red. Let's go now to the BBC. And this is where we'll talk about a listing here. Has the U.S. flotation bubble burst? Well, we'll see. They talk about one entity here called WeWork is in doubt. Uncertainty comes after the firm was reported to be facing pressures from its biggest investor, SaltBank. They have been in the tech business for a very, very long time, to drop its flotation plans amidst concern about the plunging value of it. The company was valued at $47 billion. That's 338 billion pounds last year, but reports have suggested it's now a price tag at less than 20 billion. Other high-profile and heavily loss-making companies, as Uber and Lyft, and a messaging app called Slack, have been struggling to maintain their initial valuations. The firm were a part of a pack of much-taunted unicorns, privately held startups, valued at more than $1 billion. And then they get into these various ones here. And this is kind of interesting. Backed by venture capitalist firms, allowed to grow while enduring big losses. The firms have faced more skepticism since listing their shares. There are worries over prospects for global economy growth, given factors such as U.S. trade and Brexit more so than U.S. trade. Some argue that a tightening economic circumstances, companies and consumers are likely to cut back their spending on such things as cab rides and workplace applications, not to mention spending on desk space hire. And this is one of the big problems here. Tech analyst there, Kramer, a founder of Research, said they're obviously very different businesses, but the connecting thread is that they are losing money, burning cash, relying on sustaining very high growth rates over time. And this is some of the new offerings out there. Uber and Lyft were used on the average some 30 times a year per person, which is not enough for the firm to make a profit. These companies are losing money right now. What it means is, and this is one of few articles I've seen that actually talk about this, they need 50 to 100 riders per active user per year. Requires a fairly large size of what are discretionary consumer purchases. Uber and Lyft need consumers to use them more and more, but in a tight economy, this growth may be hard to come by. In addition, questions there. WeWork. This is Adam Newman here. WeWork offers office space, often to small startup ventures. Critics say it must fulfill long-term contracts with landlords while using short-term contracts. It is customers, making it vulnerable to downturns should its custom dry up. The company has lost $4 billion since 2016, burning through capital even as revenue has doubled each year. WeWork said in its IPO that it could slow its expansion dramatically if it needed to become profitable. WeWork lost $1.9 billion on revenue of $1.8 billion. It lost an additional $904 million on revenue of $1.54 billion in the first quarter this year. Not so far. It's not made a profit, but starting in 2010, it had rapid growth, spreading to 528 locations in 111 cities and 29 countries. Turning to Stick, the workplace communication app was offered as a competition with an offer from Microsoft. If you're buying Microsoft business, you're already getting terms built in. Microsoft Term is a unified communications platform combining workplace chat, video meetings, file storage, and application integration. Hard to beat that type of situation. Teams may not yet have all the features that Slack offer, but buying Slack becomes an optional purchase. Slack is also appealing more to startups that want to use new tools. Well, so that is Slack, and where Slack is. Let's do the numbers here. We'll start with the FTSE. FTSE 100 closed 0.31%, or 22.79. In Amsterdam, they were at 2.04. In France, at 12.60. In Germany, the DAX was at 28.28. Nice week there. The Euro DAS 50 at 11.25. And in Madrid, they were at 55.60. And in Bombay, 280.71. The Hang Seng was at 265.06, and the Nikkei was at 228.68. Return to the U.S. before we do the commodities. Basically went over this. The Dow at 39.07. That is 0.14%. And basically 27,219.51. The Nasdaq, it was in a negative at 17.76, or a negative 0.22% there. The S&P in Chicago at a negative 2.18, or down 0.07% there. Let's do where petroleum products is. I think we announced the death of T. Boone Pickens. We'll see, though, how he's doing. Petroleum products, this is Brent crude futures, were down 16 cents at $60.22. And West Texas crude at $54.85. It was down 24 cents, or 0.44 percent there. T. Boone Pickens is looking down or up, or wherever he is, sideways and smiling. To gold. Gold at $1,515.20. It was up $24.55 on the Forex, or 1.65% for gold. So gold is moving along, as one would say. The currencies were doing okay. The Japanese currency was down 0.0300. The U.S. currency didn't move. Let's see, where is it? The euro. This is actually against the euro. And the old euro, where was it? Against the Japanese currency, didn't move. The basic currencies here. 1 pound buys 1.289 euros. And it would also buy $1.25 basically there. That is where the pound is. And with the yen, it would, what is it, 135.1111550 there. So that's where the currencies stand. And let's see if we can find anything else here to talk about. Okay, we got the flotation here. Healthcare. We'll talk a little bit about it. This is from the U.S. Census Bureau. Healthcare insurance is a means for financing a person's healthcare expenses. Year to year, the prevalence of healthcare insurance coverage and distribution of coverage, many types of there. So, the report presents statistics on healthcare insurance coverage in 2018 and changes in healthcare insurance coverage between 17 and 18. The statistics in the report are primarily based on information from the current population survey's annual social and economic supplement. You'll hear that out here many times. And from the Census Bureau. They define what is private coverage. That's employment-based. Direct purchase can also be there. And TRICARE, coverage through TRICARE, formerly known as the and Health and Medical Program. That's from the services. Then we have the public. We have Medicare, Medicaid, and VA Civilian. I'm not sure what that one is. Highlights. In 2008, 8.5% of people, or 27.5 million, did not have health coverage at any point during the year. It's 2018. The uninsured rate, a number of persons uninsured, increased from 2017 at 7.9%, or 25.6 million. A percentage of people with health insurance for all part of 2018 was 91.5. The 2018 private insurance coverage continued to be more prevalent than the public coverage at 67.3% of the population, 34.4% of the population respectively. Subtype health insurance coverage, employment-based insurance remained the most common, covering 55.1% of the population for all or part of the calendar year. Between 2008, the percentage of coverage with public coverage, percentage of people with public coverage declined 0.4%. The percentage of people covered by Medicaid, and we just crashed. Anyway, nonetheless, we'll leave it at that, and that is a picture of insurance. More people are uninsured today than ever before. That was the point that we wanted to make here, and we made it, I guess. The system does crash occasionally, and it did crash here. Very unusual in the crash, but we have done the numbers. Nonetheless, this is a Numbers Man on the 14th of September 2019, and in the Jerry Pippen Memorial Broadcast booth. For those in business, make next week a productive one. Obviously, the consumer is keeping the eye on the prize. In the debates, that's on our political side, Bostonred, we invite you to listen to some of those programs. I believe on Friday Java, we talked about not only the debate, but healthcare, Medicare for all, how it came out in the debate. And we have the debate transcript, I believe, on Friday Java there. On the week that was, we talked more about that. In other words, it's one of those situations that is talked about many times. And we're trying to get healthcare coverage back again here from the Census Bureau. I'm not sure if we'll append this or not. We'll have to think about it, and it's back. Things collapse, but they sometimes come back. Anyway, let me just kind of as an appendage here, this is the percentage of people with private coverage of any of the three types, including what they call TRICARE, did not statistically change. The percentage of uninsured children under the age of 18 increased by 0.6. And this is some of the summary here. Medicaid coverage at the time of the interview decreased by 0.7 points. Medicare coverage at the time of the interview increased. It decreased on the Medicaid. This is between 2018 and 2019. We definitely wanted to get that little situation in here. Types of coverage. Percentage of coverage by types of coverage at the time of interview and change between 2019, the uninsured at 9.1, health insurance at 90.9, private plans, let me see what we had here, 66.1, nice graphic here, employment based at 54 there, and direct purchase at 10, the TRICARE is a military plan at 2.6, the public plans, Medicaid at 18, Medicaid at 17.3, Medicare at 18. That is how it came out. Many people may have health coverage for part of all the calendar year amongst the 296.2 million people covered at any point during 2018, most 96.4 had healthcare insurance for all 12 months, while 3.6 had coverage for 1 to 11 months. That is, most people with coverage during 2018 had coverage through the entire calendar year. Similarly, the majority of people with private coverage, 95.2%, and public coverage, 94.2% there, were covered the entire year. Only 4.8 and 5.8 percentage with private and public held that type of coverage for part of the year. So a little different here with the various health plans, full year coverage and part year coverage. Nice graphic here. The Medicaid types were 91.2. That was full year coverage, and 8.8 part of the year, and public plan here 94.2, 5.8 were out of it. One or more types of coverage during the year, concurrent 12 months coverage, and 1 in 10 anywhere. This is a very good graphic. We'll probably put this up so people can look at it. This is from the Bureau of the Census. In 2018, 94.1% of adults aged 65 and over were covered by public plans as primary Medicare, and 54.4 were covered by private insurance plans. Between 2017 and 2008, the percentage of adults 65 and older coverage decreased by 1.3%. Overall rates of insurance and public coverage did not statistically change. Children under the age of 19 had lower overall rates of coverage. Senior citizens 65 and over, that rate from 19 to 64. Children likely to be influenced by some children from low-income families being eligible for health care through programs such as the Children's Health Care Program, CHIP, and Medicaid. So we'll leave it at that, but we did get it back. This will do it for us. So we'll see you next week, as Paul Harvey would say. Good day.